So we are going to start with the reading for the question. So pay attention, see if you picked up the same issues, that you have the same concerns. We'll go through the reading time, and once we've done that, we'll move on to the required. Please remember that you should also attempt this question yourself first, and only watch this video once you've marked yourself and you know where you've gone wrong and you've seen the issues that maybe thwarted your attempt at passing this. Okay, so let's start. This question consists of two unrelated parts, part A and part B. Always pay attention to this when they give you these type of information questions. If they're unrelated, that means you can do part A and part B separately. But if they're related, you need to see what the link is there. Sometimes that has a big effect, sometimes it does not. But do pay attention to it and be aware of it. Right, so part A. It says Molecule Pty Limited is a resident company with a December year end. Right, so nice. It runs from the 1st of January until the 31st of December. I like to draw out the timeline as I go through it also. It just kind of helps focus me a little bit. Molecule manufactures, so look out for these type of verbs. Those are important because it tells you what the company does. And if it's a manufacturing company or a company involved in the process of manufacture, as we can see here, then there are certain allowances which may be applicable. Molecule is a registered Category B VAT vendor. Remember, you can refer to the VAT Act, Section 27 for these. Means it's a 2-monthly VAT vendor. All transactions are with registered VAT vendors unless indicated or implied otherwise. All amounts exclude VAT unless stated or implied otherwise. Now remember, that's important, this excluding VAT. As a quick recap from it, remember what the concept is. This is for the application of Section 23C. And it tells you, let's say you go and you buy something from a store as a taxpayer, as a company, you buy something. So it costs you 115,000 rands. I'm putting it in brackets to show it's a cash outflow. Then you claim input tax, input VAT on that. That's a cash inflow from you because you recover that from SARS. So that means this asset actually, or this expense, whatever it might be, actually only cost you 100,000 rands. This is the amount to use for income tax. And this is Section 23C tells us that. Now remember, the same principle, understand the principle, don't just rule as all amounts must exclude VAT. So let me just show you before I continue. If this amount excludes VAT, can you see it basically excludes the amount excluding VAT? That is why they give us this usually in questions. Because they tell you, for the most part, you can assume that the work has already been done and they've excluded the VAT for you. Okay, but what happens if we buy something that's exempt, or you're not buying it from a vendor, maybe it's in something new? You can't claim the input tax then. Right, so that is then the amount that you use. This can also apply for things like where input tax is denied. Now they like asking this. This is motor vehicles, for example. And the exempt ones which I like to see often is residential accommodation. So they tell you the company goes and buys a flat and the amount excluding VAT is 100,000 rands. That flat the company is going to use to rent out to people. So it's for residential accommodation. So you then need to know from your VAT rules that it's exempt. So you would have to use this amount, 115,000. But they've given you that amount in the question because all amounts exclude VAT. So what do you have to do? You have to add that 15,000 rands back to get to that. So that's the concept about Section 23C, guys, and that's why they tell us this in the question. Okay, very standard. Molecule is registered as a small business corporation in terms of Section 12E of the Income Tax Act. Very important. Right, Section 12E, small business corporation, there are special capital allowances and there are also tax tables that apply. Right, so the special allowances, section 12E1, section 12E, sorry, E1 capital A. E1 is for manufacturing assets and E1 is for wear and tear assets. For the manufacturing assets, you can claim 100% of the cost in year one when it's born to use. For wear and tear, you can use either section 11E, the wear and tear, or you can use 50, 30, 20 rule. 50% year one, 30% year two, 20% year three. And basically we'll use section 11E if it's a shorter period or cost doesn't exceed that 7,000, because then you can claim the full amount. Right, so what I mean, remember, if I buy an asset for 6,000 rands, a movable asset, I can then claim 6,000 minus 1, so 599 under section 11E. Okay, then they tell us the details of two events are provided below. Event number 1, let's start. On the 15th of August 2022, Molecule entered into a contract with Abacus Supplies PLC, a company which is based in the USA, to purchase new IT equipment for their accounting department. In terms of the agreement, Molecule would purchase 13 computer mainframes at a cost of 2,500 rands or dollars each, and 3 tablets, so things like iPads, for example, if you're not sure what that refers to, at a cost of $800 each. Molecule would be required to settle its account with Abacus Supplies PLC on the 1st of March 2023. Right, so this is the realization date. Remember when you have to settle your outstanding debt in this case. Okay, so far what I want us to see is if we draw up a timetable, we say this is the 1st of January 2022, this is the 31st of December 2022, and this is the 31st of December 2023. Okay, so this so far, this on the 15th of August, yes, they enter into a contract, but there's nothing at this point in time that happens. Okay, that's just entering into a contract. The realization date, we can maybe just go and fill that in so long. 1 March 2023, and this is the realization date. Right, the goods were shipped free on board on the 1st of September 2022. Nice, that is the date, that's an important date for us, and that is the transaction date. Okay, so now we can already see at the 31st of December over here, that is what date, guys? That's our year end date, so that is our translation date. Remember, those are all important dates when it comes to section 24I. Okay, then they tell us, they also tell us here there were some imported duties, 2,500 rands and 1,000 rands per tablet. 2,500 per computer, 1,000 per tablet. The equipment was delivered to Molecule's business premises on the 15th of September. As this was the date that the equipment was available for use, the financial accountant correctly started calculating depreciation. Now, is that correct if you think in terms of financial accounting, IAS 16 and so forth? Yes, that is correct. Is that what we do for tax? No. For tax, we calculate the allowances when we are doing the wear and tear. So when are we doing the wear and tear and the allowances? It's when we start using the asset in the production of income. Sorry, my brain seemed to have exploded for a few seconds there. As this was the date the equipment was available for use, the financial accountant started using calculating depreciation. The mainframe computers are being depreciated on a straight line basis over an estimated useful life of 5 years with no expected residual value. The tablets are being depreciated over the estimated useful life of 3 years and are expected to have a residual values of 500 rands each. Okay, so this is all for financial accounting. The residual values have nothing to do with tax. Right, it doesn't affect how we calculate wear and tear. Maybe if they tell you at some point in the question, now the taxpayer is selling it for an amount which is equal to the residual value, you'd use it to calculate recoupments and capital gains as usual, but they'll have to tell you something more. So it's only when there's a sale that we'll worry about residual values. It does not affect our wear and tear. We don't reduce our depreciation in the same way. Then, Molecule did not, however, start using the equipment until the 1st of February 2023. Okay, so that is something to be quite aware of. Right, 1 Feb 2023, start using. Right, then, Molecule was concerned about fluctuations in the exchange rate, and on the 1st of October 2022, it took out a FEC that will be settled on the 1st of March 2023, which is the date of the realization, at a forward rate of 16 rands 20 to the USD. Okay, so 1st of October, this is also then a transaction date. This is a different transaction date than for the debt, but that's obviously very possible. Right, so let's just use a slightly different color here and say 1 October 2022. This is transaction date also for the FEC. Okay, so now, in the year ended 2022 up to here, you should now already see that we would have calculated the forex gain or loss from the transaction date to the translation date, right, like that. And we would also calculate forex gain and loss from the transaction date of the FEC to the translation date. Right, so I'm just going to show it over there. And this would have all been in the 2022 year. However, we only started using the asset in the 2023 year. So, section 24I7 will apply. And what does section 24I7 tell us? Section 24I7 is a section that tells us that these forex gains and losses here must be transferred, must not be taken into account in 2022 like this. They must be taken into account only when we start using the asset. So they must be transferred and just taken into account into the next tax year. In the next tax year, we then calculate also forex gain and loss from the translation date to the realization date. Right, so for this period over here. Okay guys, so that's pretty important for us to see. And I'm going to just remind you here, capital allowances, we must refer to section 12E. And I recommend that you do the same for yourself. It's very easy to forget the fact that this is a small business corporation. And then you'll lose out on easy marks. They then give us some spot rates on various dates. The 1st of September over here is a transaction date. The 1st of October over here is also a transaction date, but that's for the FEC, so we're going to use that rate over there. This is the translation date, and this is the realization date. The table below shows the forward rate for FEC contracts to purchase US dollars with varying maturity dates as at the 31st of December. So they're giving to us as at the 31st of December translation date. They are giving us some rates, and that is to use for the FEC. Now, this FEC, when is this FEC going to be paid and be settled? On the 1st of March 2023. So in the new tax year, remember our tax year starts in January, It's January and February are gone, so this is a 2-month FEC. So we are going to use this rate over here. Right, then the extract below is from page 22 of Interpretation Note 47, issued by SARS, showing the proposed Section 11E write-off periods for various assets. This is actually from Interpretation Note 47. Now what I want you to see is we've got two computers here. Here's our mainframe computers with 5 years, and here's our tablets with 2 years write-off periods. Now remember, Section 12E1A, you can use either Section 11E, so you'll use these rates, or you can use 50, 30, 20. Now can you see, for these computers over here, written off over 5 years, we're going to use the 50, 30, 20 instead. Because this writes it off over 3 years, and this is written off over 5 years. For the computer tablet, 2 years. So we'll use Section 11E for that. Then we have event number 2. Molecule sold machine X on the 25th of August 2023, so in the 2023 year, for 1.5 million rands to a non-connected third party. Molecule had purchased, and I'm just reminding you, remember guys, this is all excluding VAT, because they tell us at the beginning of the question, all amounts exclude VAT. Molecule had purchased and brought into use machine X on the 24th of April 2021, so the 2021 year, at a cost of 2 million rands, and had been used in the process of manufacture. Now, you want to go and say Section 12C, 40, 20, 20, 20, but you need to remember Section 12E1 applies, and that says 100% in year 1. This is not a choice, you must use this one. Under Section 12E1A, you have a choice per asset, but here you don't. So it's not Section 12C. Please remember that. Molecule signed a contract with a supplier to replace machine X with machine Z, which is or Z, however you want to say that, which was an upgraded version of the older machine. Machine Z will have a cost of 1.6 million rands. Now look here, this one is sold for 1.5, this one is sold for 1.6. So immediately you need to start thinking about paragraph 66. And if paragraph 66 applies, section 8.4e will apply. Paragraph 66 applies to the capital gain. This is the, deferred, that's the capital gain, if there's a capital gain, and this is the deferred recoupment. Remember guys, you have to go and revise this if you can't remember this. The rule says, this quickly, you need to, if it's paragraph 66, this is not an involuntary disposal. Then they tell you you can replace basically most assets with each other, wear and tear assets, section 12C assets, section 12E assets. You can't just use buildings, but you can replace them with each other. But the cost of the new asset or assets must be at least the same or more than what you received for the sale of the previous asset. So the idea is here that you must take that full 1.5 million and put it into the new machine. There mustn't be any money left. Then you can defer it and you write it off. How will it work? You defer the capital gain and you write it off as the new asset is written off. They tell you then that this asset was only born to use during the 2024 year of assessment. So the capital gain and recoupment deferred to 2024. Part B, I'm just going to discuss in a separate recording.